Welcome back. Just want to correct something we said in Notable Calls. Stifel has a price target of 19 Canadian dollars on shares of Algoma Steel. Let's go to our first call. This is the segment where you, the viewer, get a chance to put questions directly to an investing professional. Gavin Graham is our featured guest. He is, of course, a longtime market professional and contributing editor to the to a couple of high-profile newsletters, including the Investor Income newsletter. Let's go to Ben. Ben is in Alliston, Ontario. Hi, Ben.
Yes, hi there, Paul, and good morning to you, and good morning, Gavin, as well. You have provided me, sir, with so much value, over the years, and I thank you so very, very much for that.
Thank you,
Gavin. I wanted to ask you about Northland Power. I know it's trading right now about half of where it was in around 2020. So I imagine it has some tremendous upside. I just wanted your thoughts, Gavin. Thank you.
Thanks, man. Well, absolutely. And this is the same story as Boralex. As you said, they were way higher in 2020, 2021 when everyone loved green energy. Now it's barely half the price, even though the outlook is no worse and in fact somewhat better because they've got some of their big projects like the Baltic Power one are now at least papered and due to start. These are very long duration assets. So whenever interest rates go up, they are badly affected. And also, of course, especially if you're a green renewable energy producer like Northland, like Boralex, you have a bunch of projects coming on stream which take time, and therefore when the price of money has gone from 0.25% to 5.25%, it's a negative effect. But certainly the upside from here is pretty good, and you're getting a decent yield. I think it's about 4.7% or something like that.
Okay, thanks for that call from Ben in Alliston. Let's go to Albert. He's in Cobourg, Ontario. Good morning, Albert. Thanks for calling. What's your question to Gavin Graham?
Good morning to you both. Thank you for taking my call. I've heard several pundits saying that it's a good time to invest in healthcare stocks. I've been watching the big three providers in the U.S., United Health, Elevance, and Humana. And although they look to have outperformed the S&P in the long term, they've been relatively flat the past year and just suffered a recent drop in price. Is it a good time, do you think, to invest in United Health, given it's also an election year and the cost of health care seems to be ever increasing?
You're right. United Health is vulnerable to worries, just like the drug companies, whenever you have an election year. But the fact is, it is the major healthcare provider in the US. It's the largest by market cap. And also, as you can see from the charts, it has been somewhat weak over the last little while. The longer term demographics for these companies look pretty good. The difficulty is finding the staffing to look after people. So longer term, you should be fine, but there may be some short-term turbulence.
Okay, let's go to Scott. Scott is in Mitchell, Ontario. That's in eastern Ontario near Perth. Hi, Scott. Thanks a lot for calling.
Good morning to you both. Yes, my question is to Gavin about Finning International and where we are in the economic cycle. I'm just wondering if this is a good time to get an entry level into Finning. It's kind of bottomed from its highs and looks like it has an upside move on it. And I'm just wondering your thoughts on that. And Paul, if I could get the street consensus on the stock, that'd be great. Thanks so much, and I'll hang up and listen to what you have to say. Bye-bye.
Indeed. Well, thanks for the question. And yes, Finning is obviously down somewhat from where it was. You're a provider of really big pieces of kit, especially to the mining industry. We've heard all about the green transition. This is one of the major providers. Finning has a very big exposure in Latin America. Maybe one of the reasons why its former CEO is now the boss of Scotia, which is the bank with the biggest exposure in those markets. He knows them well. So getting into it now is not a bad idea. Again, if people are worried about a recession, then there'll obviously be a concern about the demand for capital equipment and the use of these. But really, the longer-term outlook for these stocks looks pretty good.
Okay, and in terms of the analyst consensus, Scott, there are 9 analysts that cover Finning International. 7 say buy, 2 say hold, none say sell, and the aggregate price target, or the price target compiled by this survey by Bloomberg News is roughly $48. I see the number $48.22 Canadian, and there have been 4 ratings that have been refreshed or updated since December. One as recently as January 11th this year. Amin is in Ottawa. Hi, Amin, and thank you so much for calling. What's your question to Gavin Graham?
My question, good morning, Gavin Graham.
Good morning.
My question is his 7 best stocks in his view.
I presume means you feel that maybe the so-called Magnificent Seven, the mega cap tech stocks in the States, which have led the market and been responsible for almost all of the increase over the last year or so, are not necessarily the Magnificent Seven. I would be in agreement with that. I would suggest, as we have discussed through this hour, that buying things that are maybe somewhat more reasonably valued in an environment where interest rates are peaked and are going down, and where, having been interest rate sensitive, they've underperformed, would be a good thing to do. So maybe you get some, pipeline, utility, telco, but financial. But maybe you also get some energy and some mining materials stocks as well, because they're maybe more economically sensitive, but they're also going to be beneficiaries of the increasing demand for what they produce.
Okay, thanks for that question. I mean, Chris is in Toronto. Hi, Chris.
Good morning. Nice of you to take my call. Gavin, I'm kind of an immigrant from a bank stocks, and I'm thinking of going to Alimentation Couche-Tard. You think that's a good move? I mean, alimentation's gone up recently. Maybe it's fully funded at this point. What do you think?
No, I wouldn't agree with that, in that Alimentation Couche-Tard always looks expensive, but it always seems to deliver in terms of growth. This is the exception to the rule that no Canadian retailer can ever be successful outside of Canada. We have so many examples of people who've done badly. Couche-Tard just is a machine, and whether it's in Europe, whether it's in the US, it just continues to buy up service stations, sell you lots of expensive beef jerky and slush puppies. The question is whether or not, with the fossil fuels being phased out gradually, people will continue to call to pay for the overpriced stuff. But maybe if they've got quick chargers, that will address that. And in the meantime, there's a good runway of another 10 years or so, at least, for Couche-Tard to continue to execute exceptionally well.
And I can tell you, Chris, that the analyst consensus is strongly bullish as well. Of the 17 analysts who cover Alimentation Couche-Tard stock, 15 say buy. Let's go to Terry. Terry's in Ottawa. Terry, thanks a lot for calling. What's your question to Gavin?
Hi, Gavin. Could I get your thoughts on Brookfield Asset Management? Thank you.
Yep. Well, it's actually a recommendation in the Income Investor. It's not a particularly high yielder. And in fact, they actually spun off the asset management side from Brookfield Corporation. So the Brookfield Group's ability to actually split its operations into various bits and pieces of paper never ceases to amaze. But actually, you've done pretty well in virtually all of them, whether it's the renewable energy or the infrastructure or whatever. Brookfield Asset Management, their asset management business continues to go great guns. They are successfully launching new funds and raising several tens of billions for some of their products. You have to live with a low yield. And interestingly, again, it's actually been somewhat a victim of its own success, in that, having done really well, it's sold off along with the rest of the asset management industry over the last year or so in a rising interest rate environment. But it's still a good long-term hold.
Gavin, thank you so much for joining us on behalf of all of our viewers, and thanks to those viewers who put in calls as well. Always great to have Gavin Graham with us. We'll look forward to having him back again sometime soon.
Well, Netflix is betting there's another way to get even more viewers to use its platform by getting them to tune in for live shows. It has landed its first long-term deal that aims to tap into the loyalty of WWE viewers. Netflix has acquired the exclusive rights to World Wrestling Entertainment, including its flagship Raw show. Financial terms of the deal weren't disclosed, but there are multiple reports that it is valued at about $5 billion US over 10 years. Raw will air on Netflix in Canada, the US, and other markets starting in January of next year. WWE's president says the deal is a good bet on both sides.
For us with Raw, it was yet another test of someone new in the space, obviously an established streaming entity, the streaming entity, if you will. It was a good bet by us, and we think a good bet by them.
Well, let's see what this deal means for the live sports streaming ecosystem with Adam Seaborn. He is a sports media analyst and head of partnerships for North America at Playmaker Capital. Adam, thanks so much for joining us this afternoon.
Yeah, good to be with you.
So how significant is this deal, looking past the dollar figure, if it really is $5 billion, but just the fact that Netflix has landed this live component and it's looking at it over a long-term period?
Yeah, I think this is a landmark deal for Netflix. I mean, we've heard a lot about Netflix wanting to get into the live event and entertainment business. Obviously, they've dominated the streaming landscape when it comes to scripted programming. In the last few years, they have toyed around with live events. They've done some live comedy specials. Most recently, they did kind of an exhibition golf match between the PGA Tour professionals and some F1 stars from the Drive to Survive show. What we haven't seen from Netflix is them actually get into the sports rights deals until today. This is a 52-week deal. There's going to be live sports on Netflix starting in January 2025. That's a really big deal for their business.
What do you think about what Netflix could do in terms of strategy to keep people who are interested in sports on Netflix? Because, there is churn, right? You could just sign up and watch what you wanted to watch. Let's say if there was a particular event happening, and then unsubscribe. Is there something that Netflix will need to do to make sure that those subscribers who come for sports or, in this case for the wrestling actually stick?
Yeah, I mean, what's interesting about this deal is obviously for TKO Holdings, for WWE, they get the reach of Netflix. They also get to double their media rights value. So huge opportunity for them moving from NBC Universal, Peacock in the US, and here in Canada, Sportsnet. But for Netflix, what they get is 52 weeks of live event programming. It serves two purposes. One, as you mentioned, when Netflix came out, the ability to binge television was a novelty. Imagine you can watch an entire season of a show in a weekend or in a week. The problem with that is it made it very easy for users to churn out. You subscribe, you want to watch Stranger Things, you watch the whole season, well, you unsubscribe and I'll subscribe next year when the new season comes out. 52 weeks of sports programming keeps you tied into their programming all year round. So It's going to really reduce churn for those users. Now, the other thing is their AVOD business. What hasn't been talked about enough is that the reason that you need to have sports programming is to bolster that advertising ecosystem. Sports are built around ad breaks and around ad ecosystem. We know that Netflix has a lower price tier now for advertising, and they've had some success building out the ad tier, but they need ad inventory. And by having ad inventory in live events, you all of a sudden become a major player when it comes to sports advertising.
You posted on X earlier today that this deal creates a hole for Sportsnet's schedule because WWE programming in Canada was previously on Sportsnet. So how big of an impact do you think that will have?
Yeah, it'll have so about 7 hours a week. We're live on the linear Sportsnet channels, which is significant. It's not a huge amount. It's not as big as the Blue Jays or hockey or anything like that, but it's still a significant amount of programming. But I think what's more interesting is that, one, despite what people might think, wrestling is as popular as it's ever been. It was driving significant eyeballs against that young male demo, which every advertiser's after. So they were going to lose some ad revenue against that. That's going to be hard to replace. And they were also putting a lot of this wrestling content on their Sportsnet Plus product as well as Sportsnet 360. These are not just the kind of core ad tier or cable bundle. This is that next level up where they're really extracting a lot of subscriber value. Subscribers of Sportsnet Plus or 360 are going to ask, is it worth it for me to have this cable package anymore when a main thing I have is on Netflix?
Adam, what do you think Netflix could do in sports beyond WWE? Could there be a hockey night on Netflix instead of a hockey night in Canada? What do you think?
Absolutely, there could be. And I think that the next rights deal to keep your eye on is the NBA. The NBA built an in-season tournament this year. A lot of people think they built that in-season tournament to attract a streaming partner who can essentially say, hey, I'll buy the in-season tournament rights from you. Netflix is definitely in the conversation for that in the US. In terms of Canada, hockey rights, which everyone talks a lot about here, because obviously it's the number one sport, they come up in 2 years. Sportsnet is the exclusive national provider, and then there's a regional deal with TSN. That deal will certainly not go back to Sportsnet in its entirety. They are negotiating. I would be absolutely shocked if the whole deal goes back to Sportsnet. Someone like Netflix, someone like Amazon, someone like Apple, Roku, even players we haven't thought of yet are going to be in the mix for those rights.
Adam, so great to get your thoughts today on this. Thanks so much for your time.
Yeah, thanks for having me.
That was Adam Seaborn. He's a sports media analyst and head of partnerships for North America at Playmaker Capital.
We are continuing our breaking news coverage of the Bank of Canada's latest interest rate decision. Now, the bank held rates steady at 5% this morning, continuing a trend we've seen for several meetings. But for the first time, the bank indicated it won't need to increase rates again if the economy evolves in line with its own forecasts. Officials saying the data shows economic growth has stalled, will remain slow in the near term. That should help bring inflation back towards the bank's target level heading into next year. We are going to hear from the Bank of Canada Governor Tiff Macklem coming up at 10:30 Eastern Time. There is a press conference scheduled. In the meantime, we've got a great panel here on the Open. Sticking with us from last hour, Don Desjardins, chief economist at Deloitte Canada. We're also joined by David Wolf, portfolio manager at Fidelity and former Bank of Canada advisor, and Ed Devlin, founder of Devlin Capital, former head of Canadian portfolio management at PIMCO. It's great to have you all with us here. Don, I'll come back to you. We were covering the breaking news 15 minutes ago, and for the first time, we're seeing more of an indication that the bank is leaning towards rate cuts without going all the way there. What is the balancing act that's at play here right now?
Well, it is the idea that, we're in a slow growth environment. Inflation is not performing exactly the way they'd like, but certainly we have seen significant improvement on the inflation side. I think it comes down to, and to some degree, inflation expectations. When we looked at the Bank of Canada survey from the consumer side, it's not until 5 years out that consumers expect inflation to get in that lower, in that band of 1% to 3%. So I think that's a little concerning from the point of view. It's quite sticky from the consumer side. On the business side, they say we'll probably see a 2.7% inflation rate 2 years forward. So a little better, a little closer. But certainly, I think that is something, along with the wage growth, of course, wages being a little stronger than most of us, I think, anticipate. And we do think, like the bank, that wage growth will decelerate as we work our way through 24.
Ed Devlin, how's the market supposed to react to something like this?
Well, I think this is pretty much as expected. The one thing that I've been keeping my eye on, and I think it'll be something that they're going to have to address at some point, is the balance sheet. I think right now the market's pricing in 100 basis points of rate cuts this year, starting in kind of June. That kind of lines up with my expectations. So for the last little while, I've been saying buy bonds, yields are too high. I kind of looking at them a bit more fairly now, I think, in terms of rate cuts priced into the market. The thing I think is going to be really interesting to watch is there's a huge supply of bonds that need to be bought because the bank is no longer refinancing the deficit like they used to, and they're going to have to be picked up by folks like David and and myself and others, and that is a completely different yield than where the bank would buy them. And so that is, to me, a wall of supply. By the way, it's not just a Canadian thing. It's a little worse in Canada, but it's the Fed and everywhere else. And so if you think, the way I think of it kind of conceptually, I think of it like we're a little bit in the world of Japan, the Bank of Japan. You know how they had to yield curve control? So they have to control. They have a policy rate, but they also are targeting further out the curve. I don't think they'll do yield curve control, but just the size of the balance sheet will be affecting it. And so I don't think they can ignore that until, say, they've dropped their rates to the point where they want to. I think they have to address it before then.
So just because there's a PIMCO connection between you and Bill Gross, who was making headlines yesterday tied to the U.S., and he seemed to be indicating that idea of so-called quantitative tightening is something that the Fed should rethink. I guess if we're thinking about it just in terms of the economy itself, if the Bank of Canada is moving away from basically being a support with its balance sheet, how should they think about it, going forward?
So I'd love David's thoughts on this, but I was going to say the way I kind of think about it is what the central banks tend to want to do is just use monetary, like their policy rate, as their main tool, and then maybe use forward guidance or some chatting to the market, and that's traditionally what they do. Unfortunately, they've been put in this situation where they have these massive balance sheets, and I think what they normally would like to do is run the balance sheet back to where it was before, and then just use the policy rate up and down. And I think given the structural nature of the deficits that we have, there's a fundamental mismatch between supply and demand, I think. Okay. And so what you could easily see is the policy rate, if they don't address it, you can see a policy rate dropping and term rates not. And then next thing you know, you're not going to get the easing you want. So there has to be an adjustment that has to be made. And this is, like I said, the Bank of Japan's already dealing with it. We've got to find a way to deal with it.
Over to you, David Wolf.
So first thing I'll say is I'm still stuck on Ed's comment about us looking like Japan. I mean, that's not really a great comparison given what Japan has been through for the last 30 years, and that's a pretty daunting thing. If
I don't think we'll become Japan. I'm just saying it's two policy tools. That's all I'm saying.
Yeah, no, and that's quite right. I think one thing I want to return to is this notion that the bank thinks it's done, and they took out, as you mentioned earlier, the statement about being prepared to raise rates further. That's not in there anymore.
Yeah.
And I think that's a pretty clear signal that they think they're done. The caution I would give is the bank did exactly the same thing a year ago. As you remember, so January 2023, the bank basically signaled, we think we've done enough, that rates have gotten to a point where we think the economy will slow sufficiently to bring down inflation. That's all fine. And they were wrong, which is fine, because you never know what's going to happen in the future. But as you'll remember, in June, the bank resumed raising rates because they thought they had done enough, and as it turned out, they hadn't done enough. And so the same thing can be true here. So we have to be very cautious about interpreting their statement or their implication that tightening is done with a firm conclusion that it's actually done. I don't think they're going to raise rates further, but we can't be certain of that.
And is inflation ultimately the determining factor there?
Inflation is the determining factor. It's the target for the Bank of Canada. It's what they're focused on achieving in terms of that 2% target over the medium term. And the growth environment is really just a method of getting to that inflation target. And a way to think about that is the bank is forecasting basically a stalled economy and some rebound into the latter half of this year and then into 2025. They think that is associated with inflation to target, but it may be, and this is my personal suspicion, that you actually need something quite a bit weaker than that in order to return inflation to target, given, as Don mentioned earlier, the stubborn stickiness in shelter price inflation, and we can talk about that, in wages, the underperformance of productivity, et cetera. So this is what they think is going to happen, but we shall see.
Okay, so let me start to piece some of this together with all of your own expectations, tying it back to the market. So, Don, we were talking before the break about how it sounds like you wouldn't be surprised if come April, the bank was, let's say, ready to cut rates. Already today, we've had a discourse on how aggressive the rate cut campaign could look like this year. We had Carl Schmitt on last hour. He was talking about maybe 3 25 basis point moves this year, but you were saying 100 basis points is
what's priced in.
Is what's priced in.
Yep.
And I would assume each of those is like 25. So the market is thinking
starts in June and does 4 rate cuts by December.
And so I guess going back to David's point, we got to watch the inflation front. But David, don't we also have to watch, if we were to go beyond that amount, if that's a reasonable expectation by the market, and I guess that's up for debate as well, would that indicate a notable deterioration in the economy itself if they were going to go further than that?
Yeah. I mean, basically, the bank lays out its forecast as here's what we expect on growth, here's what we expect on inflation. And if we get something different, then their reaction is going to be different. So the bank is forecasting basically zero growth over the next couple of quarters. If that's weaker, if we get negative numbers, that will bring forward whatever their expectation is on easing. The other thing I'll mention, and it's something that I don't think is very well understood about the way the forecast is put together. There are rate cuts in their forecast. They don't tell us what they are and how much, but the way the forecast is put together, you have the economy in balance and inflation on target at the end of the forecast period. So really what's moving around in there is what the bank thinks it has to do in order to produce that recovery in demand, going from 0.8% growth this year to 2.5% growth. Now we know the current policy rate is 5. The bank thinks that neutral is probably 2.5. So to get to that nice balanced inflation on target environment, in a couple of years, you need the policy rate to be going towards neutral, maybe not all the way to it. So that's, 200 basis points of rate cuts. We don't know, and this is an issue that I've had with the bank for 20 years in terms of, it seems to me that if you're giving a forecast of growth and inflation that's conditioned on a reaction of monetary policy, you should tell us what it is. And the Fed does that, and other central banks do that. The Bank of Canada doesn't do that, and I understand to some degree why, and it's an old fight. But the point is that I can say with certainty that between now and the end of 2025, the forecast that they're given includes some degree of easing in interest rates.
So just tying it back to the markets, Ed, you were talking about how you'd look at government debt today, given all this conversation we're having about where interest rates are tomorrow. You shared your view on what you would be locking in some debt products today based on your assumption that rate cuts are going down tomorrow?
Yeah, I was kind of pounding the table the last few times you and I have spoken, John, about buying bonds. Yeah. We've had a nice rally. Yields have fallen. They've come back a little bit now. Yeah. So I would still be overweight. I wouldn't be as overweight as I was a couple of months ago. But the other thing you have to respect is what David just brought up is, the short-term inflation is really hard to forecast. Yeah. And there's a lot of factors that Don brought up. They're quite sticky. So, in terms of being an investor, it was time to be quite long before, a little less long now, and a backup on yields. I'd probably get longer again, but I'd still stay a little bit long.
Okay. So on the inflation front, three really smart brains here. Don, what is the most challenging part of the inflation story? Because, every time we cover the inflation numbers these days, it feels like at least one consideration is what's happening with the inflation that comes from higher interest rates, mortgage-related inflation, or even just higher rental prices through what's happened in the mortgage market. And I know there's a bigger conversation for Canada about just not having enough homes. But what is the stickiest part of the inflation story that could lead to this choppiness that we're talking about this morning?
Well, I think when we're looking at it from a global perspective, we've seen lots of uncertainty recently, whether it's in the Middle East or the Red Sea. We have lots of things that could disrupt our supply chains, which could lead to another bout of higher prices for energy, for food. So, these things are out of the control of the Bank of Canada. So they do remove those from some of their calculations to really get this underlying sense of inflation. And yes, it is the shelter story. But as you say, unless we have a lot of supply somehow we're hidden, we're going to continue to see this pressure on rents, for example, which are running at really fastest pace, I think, since the early 90s. So, there's a lot of stickiness in there, but they're also looking at trends below the surface. And that's where I think they worried a bit in December, because some of those trend rates that they were looking at, those core trend rates, they had started to burble up again. And that is not terribly comforting. Now, when you look at quarter over quarter, all of those rates have come down a bit compared to the third quarter. So that's the good news. But we're still in a situation where, we are seeing some components that are keeping our inflation rate higher than the bank desires. And go ahead.
Well, it got me curious. David, I'll ask you. So you referenced last January when the bank sort of made a move, and then ultimately that did not play out as was expected. Maybe it influenced the way they're thinking now. But we certainly did start to see renewed optimism in housing after that messaging a year ago. Do we need to be having a conversation just about everything that comes out of this central bank and what ultimately happens in the Canadian housing market as a complicated dynamic on its own?
Yes, it is a very complicated dynamic.
Okay.
So maybe a couple of ways to think about it. So the first is, as Don was suggesting, there are a number of different aspects to the inflation challenge. But to me, the key one is shelter. And the bank was pretty straightforward about that in the monetary policy report. This morning, it's accounting for, I believe it's more than half of total inflation at this point. And it is interest rates, but it's also rents, it's to some degree other costs of housing. And we understand why that's happening, which is We had already a pressured housing market situation. Then we brought in a whole lot of people, in many cases unexpectedly. And supply just is not very elastic in housing, so that's got to put pressure on the existing housing stock, on rents, on house prices, et cetera. And that's not something that goes away quickly. In fact, it's not something that changes at all very quickly. And so that's one of the reasons why the bank is concerned about the stickiness of inflation, that to Don's earlier point about global supply considerations, good prices, et cetera, those are coming down everywhere. And that's happening in Canada. But the domestic aspect, which is largely shelter, is going to be sticky. How sticky remains to be seen. But it's one of the concerns that the bank has with respect to if shelter inflation doesn't come down sufficiently, overall inflation is not going to come down sufficiently, and the bank is not going to be as able to ease as they'd like to be.
So, to your earlier point, the bank saying a stronger than expected rise in home prices is one of the main risks that could drive inflation higher than expected. But Ed, just back over to you, when you've talked about your belief that rate cuts are inevitable, you've talked about the mortgage dynamic of our housing market, the shorter duration mortgage market in Canada, let's say, versus the United States, the fact that over the next couple of years, we're going to see a lot of mortgages rolling over and sticker shock for a lot of Canadians who haven't really even experienced it yet. Correct?
Correct. So, yeah, I mean, I'm still in the camp that we'll have a recession this year. So, and I'm kind of in the camp that, and I'd be curious, David and Don, about your opinion, but that if you think of the risk reward or the risk profile of if you're TIF, if you're the Bank of Canada, you do not want to lose your inflation targeting credentials. And we had a little scare. It's not a Canadian thing. It was a global thing. But both the Fed and the Bank of Canada want to have that back. And so my base case is they over-tighten. And over-tightening could just be staying here at 5 for an extra couple of meetings when with the benefit of hindsight, we'll find out they should have cut. But because, you don't want to be the person and let the inflation genie out of the bottle, right? You don't want to go down as the village idiot of central bankers, kind of thing. And no one wants to do that after that. So I kind of think that's why being long bonds and long interest rates is a pretty safe way to be, because whether it happens in the next quarter or two or it happens near the end of the year, at some point, I'm pretty sure we're going to be right in this view. And so I don't know if you folks would agree.
Yeah, so I fully agree with respect to the fact that growth is likely to be weaker, and I do think that we may already be in a recession.
Exactly.
In Canada, and the numbers will show that over time. There's something different, though, happening with respect to that attitude that Ed was talking about at the Bank of Canada versus the Fed, and it has to do with the differences in productivity growth in the two countries. So in Canada, productivity growth has been very poor. And that means that the economy's capacity is not expanding significantly. And that makes it harder to get inflation down. And so the bank has to be weighing these factors, and Ed, you mentioned this, where if the economy is weaker, they want to cut, but if supply is not growing either, then they still have to be worried about inflation remaining sticky. Whereas in the US, it's a bit of a different phenomenon. Productivity has been great. The economy's capacity has been growing very nicely, and inflation has come down a lot. So the Fed, in some respects, I think, will feel itself freer to cut rates than the Bank of Canada will, because you have just a more favorable economic conjunction, in a sense, in the US than in Canada.
We saw something of a rally in nickel this week after a slew of announcements by companies that are cutting production in response to a collapse in prices for the metal. Now, nickel, used in stainless steel and also electric vehicle batteries, is down by more than 40% from a year ago because of a growing global glut. And our guest says this situation could last for several more years. We're joined by Frank Nikolic, VP for Base and Battery Metals at CRU Group, which is a commodity research house, a think tank. It's great to see you.
Absolute pleasure. Thank you for having me.
So the problem in the nickel industry, overproduction, in particular by Indonesia?
Absolutely. So since the EV boom kind of started, Indonesia has been producing a lot of nickel backed by Chinese companies. And over the 2022 and now 2023, we had 2 consecutive years of large surpluses, and we anticipate that surplus to continue over the next several years.
has the Indonesian nickel production been growing in long-term terms?
It absolutely has. So the type of ore that's being mined is very cheap to extract. The Chinese capital is incredibly efficient and quick to deploy. So, I mean, everybody on the western side of the world has been quite surprised by what they've been able to accomplish. And kudos to them, but it's driving the market into surplus, and hence we see the prices as they are.
So they can ramp up production very quickly in Indonesia?
Absolutely, yes. And we anticipate that to continue growing. And so much so that the end product is becoming a bit more sophisticated as well. So we have the NPI, which is feeding into stainless steel, like you said. And then we have the nickel sulfate, the MHP feeding into nickel sulfate, which is now also being made into cathode, which is the class 1 nickel, which is typically being the Western, let's say, game to play. But now more and more cathode is coming out of China as well.
So you worked for Vale yourself.
I have, yes, for about 2 decades. That's right.
So this would be a challenge, for example, for nickel producers in Sudbury or Newfoundland?
Absolutely. The challenge really is how to manage the slump in costs, the prices, which is, and the costs are all increasing given the inflationary pressures that we're under. So I know the industry has been in this place many years ago when the prices that went down to 9. So probably these prices right now feel like they're as bad as when they were, but we anticipate that to become even worse, particularly next year. We expect prices to go down even worse.
Wow, even worse. Sorry, you referred to 9. What do you mean there? $9,000 a ton?
That's correct,
yeah,
yes.
in London.
Yes.
Okay.
Yes.
Wow, so we have been worse. And could we see wholesale closures, more closures of nickel mines around the world?
Unlikely, for a couple of reasons. One, a lot of the nickel is as a major portfolio, is part of the portfolio of the majors, and they have a lot of other commodities to rely on, so that they kind of offset each other.
Right.
Certainly, there's going to be cutbacks in terms of exploration, in terms of sustaining capital and capital deferrals. So we kind of see a new cycle in the making a couple of years from now. On the Indonesian side, a lot of them integrated vertically into stainless, into battery production. So there's a lot of a margin to absorb the low prices that we see today. So unlikely to see more cuts, of any significant cuts to be seen.
Right.
And that's what's going to pressure prices even more. So we're going to have a chronic surplus over the next several years.
I guess the mining giants, they sort of, we'll wait it out and there'll be a nickel boom down the road.
Absolutely. Yeah. That's the beauty of the mining industry. We ride the cycles, as they say, right?
The Indonesians, of course, have been so aggressive in insisting we want processing to take place in our country. And have they been successful?
They're getting there. The advantage Indonesia has is more than half the nickel comes out of Indonesia today, and it's going to increase to probably 70%. So that gives a lot of power to Indonesia to start influencing that much of that value-add activity is brought back into the country. I think they will be successful.
And what about the batteries? Will the increase in demand for nickel to be used in EV batteries, will that be significant, say, compared to the stainless steel market?
It's going to become as predominant as the stainless steel market. That's what we anticipate. There is, always a conundrum of the nickel-rich batteries versus the non-nickel batteries, the LFP type batteries, and which is going to become the dominant. So far, it's about half and half. The LFP batteries are cheaper, but nickel batteries are better performing. So we'll see what the market kind of decides in terms of what becomes the dominant chemistry.
Frank, thank you very much indeed.
Absolutely, my pleasure.
Frank Nikolic is VP Base and Battery Metals at CRU Group.
All right, we are tracking shares of Intel under pressure after a pretty dismal forecast for the current quarter. For perspective into the quarter and what to do with the stock, we've got Jackie DeValos from Bloomberg and Matt Bryson with Wedbush. Jackie, why don't you walk us through what Intel said to spook investors?
Well, it overshadowed what was largely a pretty positive fourth quarter earnings report. What really started to rankle investors was the first quarter guidance, largely driven by a sales projection between 12.2 and 13.2 billion. That was over $1 billion less than what Wall Street was expecting. Profit projections also coming in below expectations, driven by largely three things. One was weakness in Mobileye. It's subsidiary that deals with autonomous vehicle technology. It also is contending with a slowdown in its programmable chip unit. And then its PC and server chip business is looking like it's going to come in at the low end of the company's seasonal range. And Pat Gelsinger, the CEO, tried to allay some of these concerns, saying that they were just temporary and that he actually expects sales to grow every quarter this year, not just sequentially, but also year over year.
All right, Jackie, thank you so much for that rundown of the quarter. Let's bring in Matt Bryson, who's an analyst at Wedbush. Jackie kind of alluded to the fact that while the first quarter is going to be a bit of a mess, the company tried to say, you know, things can improve in 2024. It doesn't seem like that's bringing much comfort to investors.
Yeah, I think that was really the expectation coming in. And that's in part why people were so disappointed with the first quarter guide. You had a really difficult year in 2023 for both PCs and servers. Both markets are expected to grow in 2024. And so when you looked at Intel, it felt like revenue and profitability had a nice ramp ahead. And then they gave us this poor outlook. And so I think it's that surprise that's really weighing on the stock.
And we mentioned that a lot of that does have to do with PC sales and issues they're having with the data center. What is Intel doing to catch the hot market right now, which is AI?
Yeah, so Intel has their Gaudi chip out there. I think it works very well for inference. So once you train your models, when you build applications around those models, that's really where Gaudi plays. It's really aimed at enterprises, whereas I think spend to date has really been the large cloud service providers who've been buying tons of NVIDIA chips. That's where AMD seems to have a bit momentum. I think Intel's hope is that as you start to see people use these models, that their Gaudi chip will get more traction, but it's a longer path, if you will.
Speaking of longer path, Intel is in the midst of trying to get its house in order with respect to its manufacturing process, so it can be kind of like a Taiwan Semiconductor, right? Or at very least compete with it, make components for other chip makers.
Yeah, no, I mean, that's certainly one of Intel's goals. I think if you look back at what created this difficult period for Intel, it really came down to they were the manufacturing leader in 2016, 2017, and they lost that leadership. And so that's weighed on their business. If you want to go sell those services to other customers, really the value is at the high end of the manufacturing process, and they're just behind right now. So I think if you're investing in Intel right now, even more so than AI, you're investing in management's story that Intel is going to recapture a lead in the manufacturing process. And if they can do that, it has significant positive implications, both for their own costs and for their ability to go out and offer these foundry services to other customers.
You don't rate it a buy right now. What would it take for you to get more optimistic?
Yeah, so it really comes back to that manufacturing process. So they are at the very early stages of shifting their manufacturing. Their first product on a new node just came out in December. So Meteor Lake's on 4 nanometers. It's really seeing those next set of products that are coming out. So them coming out with products on 3 nanometer, on 20A, on 18A. And as they start to hopefully execute there, that would make me more comfortable, because that's what gets them back to having the lowest cost in the industry, being able to build the best technology out there. But I want to see them do it, not talk about it.
NVIDIA, of course, is the belle of the ball. It has come out swinging over the last week or so, hitting fresh all-time highs. It's pulling back. Your price target is $600. It's rapidly blown through that. What are you going to do with this? Think you got to move up your price target? Do you think that maybe it's ripe for some profit taking? How are you thinking about that sudden sharp momentum in the stock?
Yeah, I mean, it's been pretty crazy in terms of how much the stock has accelerated. I think when you think about AI, if you are a believer that AI has a longer term has a longer term position in technology. That NVIDIA has secured a dominant position. When you think about most technologies, you tend to have one or two companies lead. So it was Intel and processors forever. If you think about cloud, it's really Amazon and Microsoft. When you think about PC operating systems, you've got the Mac OS and you've got Windows. So I think NVIDIA has established itself as the leader. And so if you believe in AI, then regardless of what happens in 2023, 2024, you believe in NVIDIA because they just have such a dominant position right now.
At the same time, what have you got in your coverage universe that maybe is a bit more of an unsung hero? The accolades for NVIDIA are so obvious and in front of us. Is there another maybe more hidden gem name that you think investors should be paying attention to?
Yeah, so the name that I have on the Wedbush Best Ideas list is Western Digital. So one of the areas that's really struggled in 2023 is storage, and it's in part you have those large cloud companies who are trying to lead in AI, moving more and more investment into that area, and so starving some of their other equipment spend. At the same time, AI lives on data, right? So you're training these models using large pools of data. The more data you have, the better the model. AI, the new AI is called generative AI. That's because it generates information. So eventually, you're going to have to spend a ton on storage. Western Digital plays both on the hard drive side and on the flash side. And I think we are going to be looking at a boom market for storage over the next 12 to 18 months.
All right, Matt, thanks so much for your insights today. That's Matt Bryson joining us from Wedbush.